Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
All right. Happy Tuesday or Thursday, whenever this podcast is going up.
We're now twice a week, so we don't know.
We are pumping out twice a week. We're on the podcast grind. If you appreciate that, give us a rating and review at iTunes or on Spotify, even though I don't think you can do it on Spotify.
And I think iTunes is not called iTunes anymore.
It's just the podcast app, yeah.
Right, yeah.
Yeah, I got to stop doing that because I always say iTunes and link it from there. So anyways, if you're listening to it on your iOS device, there you go, and you want to support Geoff and myself, feel free to leave us a rating review. We greatly appreciate it. We hope everyone is having a great start to your day, assuming that I did well and uploaded this in the morning. So we're going to be, I like this format, and people have said that they like this format as well, how we talk about an investing topic,
right?
And then we answer some questions as well, on YouTube. Okay. Hopefully they don't mind making the switch over, but we really want to make the podcast part at least worth it. We're not just going to cut it out as...
Yeah, and the podcast part will be, that's over here, will be a specific topic. So you can always just hear about that topic by listening to us on the podcast. And then if you want to hear the Q&As, which are often a lot shorter, that's YouTube.
Yeah. And so if you want to ask a question to be answered in the future, feel free to DM me at Focused Compound, or you can just send me a message, a tweet, right? And I'll sort of screen capture them and keep them in the future for future questions to pull from. So question that we've been asked a lot, and I think it'll make a good topic. It's been, what is Geoff's biggest mistakes of omission, and what has he learned from them? So not commission, so not from actually making the mistake.
Right.
This is from not making the mistake. The one that got, not making the decision to act. The one that got away.
The one that got away, yeah.
There you go.
Yeah.
So first one that comes to mind.
Well, the first one I've mentioned before is that I think is the worst. Not in terms of the return that I gave out by it, but just how obvious it was DreamWorks Animation. I've said that before because it's just one that I was sure was worth more to other studios than it was trading for in the public market. So that's just a dumb thing not to do.
You did a lot of scuttlebutt on that company as well, right?
I watched all the movies. Did lots of scuttlebutt. I went to some movies in theaters. I did quite an extensive Excel stuff with it to be able to predict what the eventual value of a movie would be based just on the opening weekend, which turns out to be surprisingly easy to do. So it's more accurate than you'd think.
What's that?
Just by using multiples and stuff that you can figure out. If you know if it's a sequel, and you know, basically if you know if a movie's a sequel, what its opening weekend was and what its second weekend was, so the percentage drop, you can predict pretty well what its total value will be over time. So those are the big factors.
Are you sort of in the Buffett camp as well, how errors of omission hurt more than actually making the mistake, or do you not really think about it like that?
They have for me. Errors of omission have. I don't want to say for everybody.
Yeah.
I've talked to some people who I'm surprised at some of the errors of commission that they can commit. So it can be worse to commit certain errors of commission. So I tend not to buy those sorts of things, I would say. But, I bought some things with debt, so it can happen. But yeah, errors of omission are worse for the kind of investor that I am. But I do know people who have invested in, have put a lot of money, into Valiant and invested in some things that were outright frauds and things like that. And so those can be very, very bad. You don't want to do that.
So so why didn't you buy DreamWorks?
I think just it didn't look cheap enough on sort of the basic value sorts of things. The price to book was never quite really below 1. The PE was never, a single-digit PE, things like that. I think it was just a mistake that way, focusing too much on the numbers that way and not focusing enough on just that I knew it was worth more to other people, other studios.
And how do you think you, overcome that, right? Where's the fine line between, paying up because it is a great business and then, not paying because it's not a book value under 1 or at 1 or a single digit PE. How do you sort of differentiate that?
I mean, today I think I would buy it because I think I've just changed as an investor a little bit that way. I think you have to get more confident in being able to, in your own appraisal of things, and be less focused on sort of what value investing books and things tell you. Spend more time away from those sorts of books and things, and spend more time making those decisions yourself. So I mean, that one is a particularly bad one, not because it went up a lot. I mean, I don't know if it would have been a little more than a double or something, probably. Not a triple. But that's bad just because it's so obvious. It's a common sense thing that I didn't do. Some other things are more, like, I don't even know if people know this, but I looked very closely at Netflix at a very low price that it had to compare to today and stuff. And I don't mind that I didn't buy it then. But do you know what the price of Netflix is now?
Yeah, I actually have it.
Yeah.
Had it pulled up from our last podcast. It is 353, but the market cap, I don't think they've split though, but it's a $150 billion market cap.
So I may have gone up 5 to 7 times since when I looked at it.
So why didn't you buy it? I mean, were you just kind of casually looking because you were interested in the business, or were you actually seriously looking as a potential investment?
I just thought if I was the head of a a Time Warner or some company like that, or Comcast, it was at a price that it would make sense to buy the whole thing. Definitely, I thought it was worth more to media type companies. But just when you compared it versus what other properties were selling for and what its future was going to be, it's not something where I have a lot of faith in their business model long term or anything, but it's going to be around in some form. I mean, even if the stock one day goes to zero, it'll come out of bankruptcy and be the exact same thing. So, the asset will be there forever. So, I just thought it was worth more. I mean, what'd you say the market cap was now?
150 billion.
Okay, so divide that by 5 or whatever. I thought that that any media company would be happy to borrow $30 billion and buy it. That they would be worth it to do that. They're going to need that outlet and stuff. Look how much they're going to put into all sorts of things of developing their own things to compete with that. Look how much Disney put into getting control of Hulu as part of their deal.
Sure.
Yeah. So but that's not what I mind because in terms of cash flows and things, that business is seriously, has always been and always will be seriously financially at risk. It makes a lot of promises to pay for things very far into the future, so it's risky.
So what have you learned from these omissions? Is it just focus more so on the business? Don't let maybe a few multiples kind of
think less about
make
multiples.
You stop.
But it's not just the business, I should say, in all these cases. It's that I thought the business was worth more than it was trading at, worth more to a private owner. And those are the things that make sense. So there's lots of other cases of mistakes of omission. In terms of like the actual return, I'm thinking, I don't know what the price of this one is right now, but probably one of the biggest ones would have been Amarim Cork, so which should be Portuguese. So Corda Sierra Amarim, something like that. And it was one I did not buy. And probably should have. It had some risk because it was in Portugal at the time when you had, do you remember the pigs? Everyone was concerned about Portugal.
Oh,
Italy, Ireland, Greece, and Spain. Mm-hmm. And those sorts of things. And Portugal was particularly, maybe not the worst, but it was particularly bad. It would have been considered more closer to like Greece or something in terms of whether it would stay part of the EU and everything as compared to like, Italy or something, which seems unlikely that would break off. And it was a not super high return on capital business, but it was a hidden champion. It was actually in the book Hidden Champions. I knew it well. So it had some debt, and there were some issues with what currency the debt would have to be repaid in versus what currency they'd be in if Portugal ever did leave the EU or something like that. So it was sort of macroeconomic concerns on it. But that's one I probably should have bought. It was very, very, very cheap.
And why didn't you?
That reason.
Got it.
If it had no debt, I would have bought it.
Do you think you would have bought it today? I mean, because you said like a DreamWorks.
No.
So you think how you've sort of changed?
Nope, I don't think I've changed on that one.
No. How do you think you've changed, as an investor from DreamWorks and maybe Netflix as opposed to today?
Yeah, and I don't think I would buy Netflix. I think it's too risky. DreamWorks was not that risky at all, and I think I would buy it today, yeah. I think I've changed that I just pay less attention to those sorts of things in terms of the multiples and things, and more in terms of just what I think the business is worth and what I pay for it. So common sense that way. I mean, that's the thing I always tell people about is that, in terms of the mistakes and things, people need to use more common sense and just thinking about it overall as the business, as opposed to getting too worked up about, the PE ratios and things like that. There are plenty of stocks that are a bad purchase at 6 times earnings. And then in other cases, there are companies that are perfectly good at 20 sometimes. I mean, we bought a stock for the managed accounts about a year ago or something, which I guess technically on a looking backwards case might have had a PE around 20 or something. But we knew that for tax cut reasons and things that were going to flow through that it wasn't that expensive. And so I would have been happy to buy it at, say, 13 times earnings or something. And I knew that realistically in a year's time or something, their earnings would be like that. And so I just bought it. So that's an example. I mean, maybe if I was thinking the way I was about DreamWorks, well, you don't buy something that's 20 times earnings, but you know it's going to be 13 basically in a year if it doesn't move up in price, you know?
Why do you think Buffett, and he always talks about a huge area of omission for him was Google?
Yeah.
Why do you think he didn't buy Google? Was it he just couldn't, and he's talked about he just didn't understand the technology? I mean, so many other companies were, I think he understood it. Why do you think he just didn't, sort of pull the trigger and buy it?
It takes a long time. He was looking at Burlington Northern for a long time, at railroads generally before buying them. He was looking at probably things like Apple for a long time before buying them. It takes a while to realize that something new is really like something old that he knew well. And he knows advertising supported media stuff. He was buying things for Geico and seeing, how Geico was buying ads, and seeing how effective it was. So, so he missed out on Google that way. It's the combination though. Google wasn't super cheap, so you have to be willing to pay up a little. Plus there's the technology element. It's new. When you have something that's new and that's not super cheap, that can be hard. Yeah. If you have any uncertainty, you don't want to pay a really high price. So if I was uncertain about the future of, giving the DreamWorks example, just because I'm saying that I made a mistake by not buying it when it was cheap, because let's say it was at 1.2 times book and 16 times earnings or something, doesn't mean that that decision's still pretty easy compared to if it was 2 or 3 times book or something. It becomes difficult with something like Google who's growing very fast. It's easy to miss those things that were growing very fast. Yeah.
Sure. So I want to take this, maybe we'll make this a podcast about mistakes.
Okay.
So what do you think is the biggest error of commission, actually making the mistake that you've made in your investing life?
That's easy. Selling too quickly.
And that's selling because you want to raise cash in a portfolio instead of because you have another idea, or what?
Sometimes because I have another idea too.
Uh-huh.
Yeah, both. Selling something that I think is really good. I'll give you 2 examples. I sold FICO too soon and I sold Nintendo too soon.
Why did you sell both of those?
They went up a lot. And I had something else,
Uh-huh. And then was it just the new company generally didn't perform as well, and like Nintendo and FICO still did a good job, even though it was, in your mind, expensive, or what?
Yeah, and I don't think they were that expensive. I just think that, when something goes up a lot, there's a real danger that you might sell it. That is a real problem you have to try to guard against.
And how do you do that?
It's difficult. You have to keep imagining that you're buying the stock today, not that it matters how much it went up in the past.
Because everybody says, one of the hardest things to do investing is averaging up.
Right.
When you get new capital, or you just want to put more capital to it because the story's changing or getting better or whatever.
Yep, that's true. Now you don't want to get caught up in that and like changing, getting more and more positive on it because you feel that the stock going up is a reinforcement of your ideas about it, which I think happens to a lot of people. But and I should point out, like in the case of Nintendo and FICO, where I invested in them and made money in them and stuff, if you do like what percentage did it go up while I owned it per year versus what percentage did it do later, like the rate of acceleration was higher when I owned it. So that's the thing. See, you always imagine when you buy a stock that if you think it's going to return 20% a year for the next 10 years, it's going to do it in this beautiful, smooth 20% a year. What really happens is it goes up 120% one year, then it goes down a little, then it goes up. And it's hard in those years when it goes up 100% or something, or even 50% or whatever, a very big number, let's say, especially if it's a very big number while the market isn't doing that. It can be hard. And especially over very short periods of time, we get that a lot. I mean, I've talked sometimes about stocks that we own that went up a lot recently and stuff. I talked publicly a little bit about a stock that did that. And I do get questions from people immediately about, okay, so are you selling the stock now? And people saying, well, I've missed it because it's gone up, and things like that. Whereas when a stock I own has gone, someone knows I own a stock or something and it goes down, they want to talk about that and, this is an opportunity in that one. And that's not necessarily the case. Sometimes it is, but there are pretty big differences between the stocks you like the most and the ones you don't like as much. So when the ones you don't like as much are the ones that go down, it doesn't change things as much as you might think. Like people think, I guess, that you like them all equally or something. And that would be great if I could create a portfolio that I liked all, 5 or 10 or whatever stocks equally. But it's not. And unfortunately, it does happen sometimes that the weaker stocks in it decline more. The ones you're less sure of. I don't want to say that like their upside is different or something, but often other people start to recognize the certainty that you saw in the, more the ones that go up in price quickly sometimes are sort of the wide mode ones. Yeah, and so that's the issue that you have. Mm-hmm. So yeah, I don't. There's lots of stocks where I liked the stock a lot as a business, talked about it, wrote about it, didn't buy it. So that's a mistake of omission. But I don't consider it one because, everything kind of had to go right for it. So I talked about like Copart and things like that. It doesn't bother me because, it worked out for them and the returns were good.
That was always kind of a more expensive stock too.
Always expensive enough that if things hadn't worked out very well, you could have lost money in it. When we're talking about things that are 25, 30 times earnings or something, that's really pushing into the category of, it sort of has to do as well as your hopes for it were. That's a high hurdle to clear. So that's very different, yeah.
Mm-hmm. Oh, that's interesting. So going back to errors of commission, so you would say that for you it would be selling too soon?
Yeah, selling too soon usually. Well, yeah, selling a stock that went up a lot too soon, sure. But you have to be careful with that because I've sold stocks that went down after I bought them and stuff. Mm-hmm. But I would say selling a stock just because it's gone up a lot, not just because, it is more expensive and things like that, but selling a stock on the basis of the price going up has been a problem for me more. Yeah, selling because I don't like the business as much has not been a problem.
You've written about it before, right? Mm-hmm. Have any of your sell decisions made a difference? I think that was actually the title, something along those lines. Mm-hmm. And you said that you would have been better off just kind of holding it, correct?
Yeah, that's true, pretty much in a lot of cases. There's some cases where that's not true, but the basic answer is if I sold for reasons just of price, that it got more expensive. Yeah, that's basically true.
Now, why wouldn't you ever just pare it back?
That's a good question.
Because you buy it all in one plop and you sell it all in one plop.
Right, and you could just pare it back, which is something that...
like Peter Rabover, he talked about, prior to Artco Capital, I think he said that one of his big things, he was an analyst and they put or whatever position he was, I'm sorry if he was an analyst, but Valiant Pharmaceuticals, right? And they kept it at like 3%. And they made a ton of money on it because whenever it would get to like 5 to 6% of the portfolio, they would just bring back down to 3% or whatever the numbers were. It was single digits.
Sequoia didn't do that.
Yeah. Exactly. And he gave that example and how, they lost a ton because they didn't pare it back. Have you ever thought about sort of doing it like that, or why do you tend to just do it all in one trade? Does it take out sort of like the bias side of it, or like the mental game of investing?
Yeah, it's just simplifying it. I've talked to someone recently about the related topic about should you sell some of this to buy some of that, and things in a way that sort of mechanically would make sense, that it should add to returns. I avoid thinking about trading it for the most part. I want to just focus on. I found to be overwhelmingly true that if I find it the best addition that I can make to returns in the managed accounts and stuff is if I find a really good business at a low enough price. So like whether it trades at 8 or 11 times earnings or something, and should I sell it when it goes up from 8 times earnings to 11 to pare back a little bit or something, doesn't seem to matter as much as finding something that a really good quality company that we're comfortable owning. Mm-hmm. I mean that based on my longer term experience investing, not in the year that we've been doing the managed accounts, because you can't measure those sorts of things over a year.
Cool. How do you think people can improve on, like, I guess, their mistakes? I mean, because I feel like for so many people, making the errors of omission tend to hurt a lot more than errors of commission. Mm-hmm. Do you think there's any sort of takeaway they can take away, or something that they can do to improve it? Is it just like the way that you think about it when it comes to DreamWorks? Does it hurt that you didn't invest in it, or do you just kind of not even think about it? You just chalk it up as a learning experience and kind of move on?
I don't think about it and move on. I don't have regrets those sorts of ways. A lot of people do. My biggest advice with that is to always make sure you pair off. If you think you made a mistake doing something, always pair off the possibility of other cases that where the decision would have worked the opposite way.
Yeah, so it's kind of like Copart, right?
Right. So if you think you sold too fast or something, also look at cases where you sold. So if let's say you think that you sold some stock too fast, that's fine. And it may be a mistake that you made. But when looking back at that decision, make sure you try to gather together all the cases in which you sold something quickly to really look at it and study it that way. Because I think I've talked before about how some people had asked when I did the senior diligence reports whether it's a good idea to avoid stocks that have high short interest. And the truth was, because the two things people suggested were, well, maybe bad performing stocks are maybe stocks that you pick that are more likely to perform badly have high short interest or are facing some sort of like existential threat or something, right? The problem is when you look at that, some of the worst performing stocks that I had written about had those issues, but some of the best performing also had those issues. So it's not a mistake overall. It's not something that you can fix overall. If you shouldn't just say, well, I won't buy stocks that are heavily shorted. If some of the stocks you bought that are heavily shorted performed really well, you need to look at it as a whole group thing.
Got it. Cool. I think that's a great place to stop. We are going to switch over to our YouTube part of the show today. So if you want to join us there, go to youtube.com and I can't believe I told them to go to youtube.com. Go to YouTube and type in Focus Compounding, and we're going to finish this part of the podcast there. I want to thank everybody so much for tuning in with us here today on the podcast app or Spotify. We do greatly appreciate it, especially if you give us a rating and review. And if you don't, we still appreciate you listening. Thank you so much. Everybody have a great day. See you next podcast. Alrighty, we are back on the YouTube side of things. Want to thank everybody if you did come over here to listen to the rest of the podcast. This is where we are going to take questions, most likely from now on. So if you want to ask a question, go and DM me at Focused Compound on Twitter, and we will pull them for the next podcast. So someone says, and I'm guessing because I tweeted out our Focused Compounding checklist.
Okay.
And on there, we talk about the coefficient variation, the CV. Okay. So he actually asked, he said, what is CV in your checklist? Yep. But maybe you could sort of hit on why you use it and how you like interpret it and think about it.
Right. So what is CV? CV is coefficient variation, which is also sometimes called relative standard deviation. It's a dimensionless number, which means that you're taking a number and you're dividing it by another number such that you don't have any units left over. So in this case, what we're talking about with that is, let's say you have a margin that averages 10% a year. And the standard deviation, which is a measure of how much variance, let's say, there is with something, how much it wobbles around, is 2%. A lot of people will look at that and say, okay, well, that means that margins vary by 2%. That's not important unless you take that 2%, divide into that 10%, and get 0.2. And that's the number you want, is the coefficient of variation. So companies that have very high margins or very low margins, if they have very little variation, that's what I'm looking for. So, Costco, very low margins, but if you look at the coefficient of variation, it's actually not bigger than you would have at companies that have 30% margins, but those margins actually vary more when compared to when the variation is scaled right to the average in the margin. So it's how much a number moves around versus its own average.
So it's predictability of it, essentially, right?
It is. It's basically a measure of predictability.
So when you think about valuing a company, right? If you could predict its sales and you could predict maybe like its EBIT or EBITDA or something, if you feel a lot more comfortable when valuing it if it's more stable, if it's more predictable.
Absolutely, yeah. So at Costco, that number might be 0.1 or 0.2. At Omnicom, something low like that. But then at many, many companies you look at, it might be 1. Mm-hmm. So it might have a 10% margin, but actually, a couple years out of any decade, the margin could be all the way up to 20% or all the way down to 0%.
Yeah.
These are things you can do very easily just by looking with your eyes at a chart, looking at 10 years of data, looking at a value line thing. They're not, statistically, we can write them down and include them in a checklist like you actually have to calculate this in Excel, but absolutely you can see these things for yourself just by looking at it. You can tell the difference between a margin that barely moves and a margin that moves around a lot. Everyone can go look at Costco's margins now and see that they barely move, and then, go look at a iron ore company and see how much they move.
Yeah. So, yeah, good luck valuing that, right? Yeah. Good. That's a good way to put it. Okay, next question. And this is kind of actually sort of, I guess, in the accounting area as well. It says, how do you go about reading the footnotes to the financial statements? Do both of you read them in tandem with the financials, or do you read the footnotes first?
I read the financial statements first and the footnotes after.
Yeah, me too.
Same.
And there's really no reason for that. I guess I just kind of like to, really, even before I guess when talking about reading a 10K, what I do is, even before, I may read like the about section, learn about the business, but then I kind of automatically go and look at the financials. I don't know why. That's just kind of like the first thing I enjoy doing. And and then I don't read the footnotes from there. I may go back up and read about the whole business through the 10K, and then I'll read the footnotes when I kind of come back down again.
Yeah, maybe we should talk about what the footnotes are to it. So footnotes are pretty extensive in a 10K. So we're calling them footnotes as if you have these financial statements and then there's, a number 1 or 2 next to them, and then down at the bottom there's going to be some little explanation. But in reality, these footnotes can be very long explanations of how they account for different things and stuff like that. And there's some standard ones that you would be looking at all the time. Big ones are like their how they account for depreciation, how they account for inventory, some things like that. Those are the some of the big ones that would vary a lot, I would think. What else?
What red flags? What's something that would be a red flag to you if you're reading the footnotes?
Well, unusual ways of accounting for certain things would be a red flag. So we're talking about the footnotes as opposed to just something I recognize in the financial statements.
Yeah.
So that would be a big red flag. Would be unusual things about how they book revenue compared to what I know about the industry books revenue.
It's like revenue recognition.
Yep. It can be. I don't want to say it's a big red flag or something, but if the depreciation is very different. I've mentioned before, like in the cruise industry, for instance, companies buy cruise ships and then they depreciate them over time. If you actually compare in certain years the depreciation expense taken by different cruise companies, they actually assume different useful lives for the ships.
Have you ever seen where they change the depreciation schedule randomly? That's a red flag, right?
Yeah, you can see where they change how they do those things. You can see a lot of times changing disclosure about things is more of the issue. So it's like they stop reporting constant currency or same-store sales or something like that. They drop something like that. They put certain things together to be an issue that way. In terms of like footnotes, red flags, related party transactions and things like that.
Sure.
There's some examples. I think I mentioned to you, I don't think I mentioned in this podcast, there was something where seemed to be borrowings that were quite high interest compared to what the corporation overall would borrow at. And so I was concerned by that. So like if I see something where a company in theory should be able to borrow at 6% a year, from a bank or something, and yet I'm seeing these things where it's issuing preferred stock to people or notes receivable to people or something that's like, 9 to 10% or something, then I'm wondering, what is that? Is that a related party thing with them? In that case, I was thinking this is some way of greasing some palms in terms of politicians and things, bringing them into a partnership or something for specific locations and things, and it just they shouldn't be doing that. So that was a concern.
What would you, and this is sort of, I guess, kind of different, but I just kind of thought about it. So how would you interpret a company spending like a lot of money on like the town where the headquarters is? Have you ever seen that? Like I always I've been reading the Fracker's book, and it was talking about Have you gotten to this part? Because I know you're reading that.
No.
It's talking about Chesapeake Energy, how Chesapeake spent like $250 million to sort of like glam up the town where their HQ was, and Aubrey's sort of rationale behind it was that, well, if this is more of a hip area, we'll get better employees because more people move here, and blah blah blah.
Mm-hmm.
What are your thoughts on that?
That might be true. Anything that manages sort of expectations about people and, what they would say, the optics of it, I don't like that way. So I did a post once a long time ago where I talked about like signs of something being a fraud or something, basically comparing it to behavior of someone who is a psychopath, And so those sorts of things in terms of focus on style over substance, a lot of things about telling you what you want to hear, even where it wouldn't make sense for them to be telling you this thing, or it doesn't make sense for them to be doing this themselves. Lots of things like that. In general, to be honest, having really high-profile people on your board, having...
it was like Theranos, right?
Yeah, high-profile people on your board is not a sign I like to see. Giving a lot to charity and stuff in your particular area, not something I love to see. Having really high... having a lot of people who are in, sort of... investor relations, communications, lobbying, those sorts of things, PR stuff, that's pretty heavy. Those sorts of things, or, any of that kind of stuff, is a concern for me. Even when if you have a company where I do notice a difference when, like, I would research companies for singular diligence. If you have a company that immediately, if you talk to any employees and stuff, is like you get referred to investor relations or something, versus companies where they'll talk to you.
Yeah.
Because that means that people in the company have been told, don't talk to anyone. You have to, send this to this person, whereas in the other companies, they'll, talk freely to you, means that they probably haven't been told by management not to talk to outsiders.
Got it. Yeah, I was just kind of curious about that, because I haven't really come into so many situations where I've seen like companies spending like tons of capital and like in like the surrounding area and stuff like that. I mean, of course, like if they rebuild their headquarters or whatever, but it wasn't just to like rebuild their HQ. It was like donating buildings and like stuff like that. I'm pretty sure.
Yeah. I mean, in general, a lot of high profile giving and stuff is not something that I would be that excited about seeing.
Yeah.
No.
Interesting. Cool. Well, that is the rest of the questions for today's podcast. If you did join us on YouTube, I want to give you a big thank you. Make sure you hit that subscribe button. What they'll do is they'll give you a notification every time we do upload a video. We're probably going to stick with this format, so definitely follow us along and subscribe to there. Also, if you want to leave us a rating review, that helps push the word out, and Geoff and I greatly appreciate that. I want to thank everybody so much for tuning in with us. We'll see you in the next podcast.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Thanks for listening.